Welcome to this short and crisp webinar. You are going to get crystal clear clarity in this very short duration, and that's my assurance. Before we get into the presentation, let me just take a couple of minutes to introduce myself. I am CA Enraja, Chartered Accountant by qualification, a teacher, trainer by passion. I started my career in banking industry through State Bank of India, joined as credit analyst, in short period elevated as team leader, credit processing, had opportunity to work on 250 plus projects, it's 5,000 crore plus size. After 4 years of stint in State Bank of India, I moved to CA practice, had my practice for 7.5 years, parallelly took teaching assignments, started teaching financial management, strategic financial management for CA, CMA and CA students. I'm also an empanel trainer with leading private sector bank for training their executives on financial analysis, working capital and project finance. Thanks to technology, today I teach 2 lakh plus students all over the world through my structured online courses, and it's because of the same technology you are also attending this mini webinar now. One more thing, if you don't have your notepad and pen, please pause the screen, go and take notepad and pen because you are going to have many key points to make note of in this session. Let's get into the presentation. Let's calculate some key financial ratios from this balance sheet and P&L, and that will give lot of information. First, let's look at what is the movement in revenue. Okay, let's try to put that here. I have captured the revenue from operations, and what is the fall? The dip is so much, it's like 2,849 crore. So if I express that in percentage, there is 17.58% drop in sales. Let's just capture that. Fine. Number 2, let's understand what is the profit margin here. To calculate profit margin, we need profit after tax. It is 698.89 crore in 2020 and 368.81 in 2021. So again, what we could see is a drop, but let's measure this profit margin. Profit margin is nothing but this profit after tax divided by this revenue from operations, and it is 2.76% in 2021, whereas it was 4.31 in 2020. So what are the reasons? We have seen, one, there is a drop in sale. There is drop in sales. Then we have also seen that there are some exceptional items, but there can also be other factors because we have to see what is this purchases cost with reference to revenue from operations. Was it at the same level? What about this employee benefit cost? Whether in terms of proportion it is increased or decreased. Finance cost. Okay, all this will contribute, but what is very glaringly visible is a drop in sale and to this exceptional items. Next, let us also look into EBITDA. So this is basically earnings before interest, depreciation and taxes. So here we have earnings before tax. Okay, with this we have to add interest cost. We should also add depreciation and amortization. So here we have the finance cost. I mean, for this discussion purpose, I assume this entire finance cost as interest cost and depreciation. Okay, so let us do that. My profit before taxes, okay, so here also we have 2 items, profit before tax and profit before exceptional items and taxes. See, these kind of exceptional items are not expected to recur. Okay, so this is what they are ideally doing. These exceptional items comes into picture. In the previous year they had positive, in the current year it is negative. So let us take profit before exceptional items and tax, which is 768.11 and 654.21. In order to arrive at EBITDA, we have to add items, right? So this is what? This is profit before exceptional items and taxes. With this, let us add depreciation and amortization, and that is 121.51 and other one is 120.97. Okay, and we should also add interest. We have it as finance cost here, which is 505.93, and 381.01. So if we add all this, we'll get our EBITDA, and this EBITDA can be compared with many things. Okay, why EBITDA is important? Because see, this is the profit this business is actually generating. After that, if it is getting reduced, that can be because of items which are beyond control, that is exceptional items, and it can be on account of taxes, it can be on account of capital structuring. Okay, but this business is capable of earning so much. That's what EBITDA communicates. Now we can also calculate this EBITDA margin by comparing it with sales. Let me take this, I'll compare it with the revenue from operations, and EBITDA margin here it is 10.45%. In the previous year it is 7.13%. See, here it is communicating something different. On look, we were under the impression that turnover has come down. On look, we were under the impression that the profits have come down, right? Because we said the previous year it was 969, but in the current year it is 1,555. But already it got demonstrated here. The previous year it was 654 profit before exceptional items, and in the current year it was 768. And in terms of percentage, that is established even more finer by computing this EBITDA percentage. We compared the EBITDA with the sales. Okay, and it is 10.45% in the current year, whereas in the previous year it is only 7.13%. So what we have computed now is, one is the profit margin and the other one is EBITDA margin. Then we have to relate many items in this statement of profit and loss with balance sheet, and that will give us a lot more information. Let's see what are the other things. See, basically we have to understand the solvency position of the business, both the short-term solvency and long-term solvency. See, these are all fundamentals. There are many other ratios, many other indicators available. We have to go deeper and deeper, but whatever I've shown so far and the other 2 or 3 what we are going to discuss are like fundamental pillars of any business. If they are fundamentally strong, then most of the other ratios will also be strong. But if these fundamental ratios are weak, then you can take it for granted others will also be weak, right? So let's look at this balance sheet. Let me make this a little bigger. Yeah, let's try to understand their short-term solvency. What we'll do, we'll take this current liability, we'll compare it with current assets. Okay, what I have done now is I have captured their current assets, current liabilities, so that we can understand their short-term solvency position. So this is their current assets and current liabilities. Let us also compute the difference between these two. We call it as net working capital, and we'll calculate current ratio now. Current ratio is nothing but current asset divided by current liability. It is 1.08. In the previous year it is 1.02. So actually their liquidity position, it appears as it has improved marginally, because from 1.02 it has improved to 1.08, and that is also evident by looking at this net working capital. That is, in the previous year long-term funds contributed for created current assets is only 146.1 crore, whereas in the current year it is 618.17 crore. That is the contribution of long-term funds for creating this current assets. It means if on-demand liability arises, it will arise only to the extent of 7,431. Still they'll be left with 618, but here they'll be left only with 146 crore. Look, despite having 9,131 crore of current asset, if all current liabilities are demanded immediately, they'll be left with only 146 crore. But here current asset composition has come down, but even now if all the current liabilities are demanded, still they'll be left with 618.17 crore that will be available for further circulation. Okay, that's about short-term solvency. We can't say that it is liquidity is very highly comfortable and all, because through our earlier sessions we have understood that if a business is having a current ratio of 1.33, then yes, they have a good comfortable liquidity position. Not just 1.33, greater than 1.33, but it should not go beyond 2:1 and all. Then that could lead to idle resources. But below 1.33 means there is always a scope for tweaking or making corrections so that they can make it to the level of 1.33. Okay, so that's about short-term solvency. Let us also look into their fundamental long-term solvency. For that information required is, we should see what is their total equity, basically the tangible net worth. Then that should be compared with total liabilities. So here if you see their total liabilities, this is the value, this is their total liabilities, and that should be compared with this equity. And if there are any intangible assets, we have to knock them off. Intangible assets and any investments, look at here under non-current assets, they have investments in properties, that's fine, but they have made some financial investments, and if those financial investments are mainly like in subsidiaries, associates, that has to be factored. Okay, so how this works is, you have to capture the total outside liabilities, then compare that with tangible net worth. So when we say tangible net worth, automatically it excludes intangible assets. So let's capture the total outside liabilities now. So I have captured total outside liabilities. Next, we should find out what is their tangible net worth. Here we have the equity as 4127.99 and 3761.00. This is their note 3, basically the fixed asset schedule, and here you will see this intangible asset. Their intangible assets are basically the computer software and mind development rights. And what we'll do, we'll remove this computer software. Whereas this mind development rights, since it can be transferred to some other person, it will fetch even in the event of liquidation. So what we'll do, we'll just remove this value, that is 11.49 crore from equity. We should also know what is the corresponding value in the previous year, right? Previous year total net carrying amount was 15.68 crore. Let's do that. 15.68 previous year, 11.49 current year. We have to see whether there are any revaluation reserves. If yes, that should also be deducted while computing this tangible net worth. So I checked their schedule 20, which deals with reserves. They have general reserve, securities premium, and retained earnings. Okay, so there is no revaluation reserve. Next, what we have to see is whether there are any investment in subsidiaries, associates. But here, one point I'll tell you. While computing this tangible net worth, what we'll do is we'll take equity, we'll reduce intangible assets, we'll reduce revaluation reserves. The further reduction of investment in subsidiary, associates, then loans and advances to subsidiary related companies, everything will come under adjusted tangible net worth. Okay, so now I'm just doing the basic tangible net worth computation, so I'm not getting into the deduction and all. But as per their note 6 non-current assets, they have various investments. They have investments in jointly controlled entities, associate companies. They have investment in debentures of subsidiary companies, also LLPs, and there are unquoted investments as well. So now let us compute the tangible net worth, which is so much for 2021 and this is for 2020. Okay, So I'll bring that here. Now we can compute TOL by TNW ratio. That is basically the overall liabilities by tangible net worth. In 2021 it is 2.15 and in 2020 it is 2.7. It means it has actually improved over the previous year on account of two reasons. One, tangible net worth has improved when compared with the previous year. Two, overall outside liabilities has come down. Okay, so in this video what we have seen is the movement in sales, the profit margin, EBITDA margin, short-term solvency current ratio and long-term solvency TOL by TNW. Thank you so much. We have come to the end of this webinar and I'm sure you would have really derived value from this short and crisp webinar. If you wish to continue this learning journey, I have an amazing opportunity for you. I have published several courses on banking and financial analysis area, each course costing 2000 rupees. But for you, I'm going to give you a special offer. Here we go. Banking credit courses bundle. This includes course number 1, banking credit analysis process. It's a comprehensive course with 200 plus lectures. It covers financial analysis, working capital, term loan, LC, BG. It's a comprehensive ever course. Then we have course number 2. That is how to carry out financial analysis as a banker. This is going to focus exclusively on financial ratio analysis, cash flow analysis and fund flow analysis. Then comes course number 3, how to carry out term loan appraisal and analysis as a banker. It's a comprehensive course focusing on the technical aspects around project finance and term loan. These are all the topics. Then comes course number 4, how to prepare CMA report for bank loan through 8 sections. This course will take you through entire CMA report preparation process for bank loans. Then we have course number 5, how to read balance sheet. So if you are a non-finance person, this course will give you complete insight into balance sheet, how to read them, how to interpret them, how to analyze them. Okay. Then we have course number 6, how to read CIBIL report. By taking this course, you will get a complete picture of CIBIL report reading process. Then we have course number 7, how to prepare cash budget for bank loans. This course will help you to understand the concept of cash budget, which is widely used in short-term lending like ad hoc credit facilities, letter of credit and all. So far I have introduced 7 courses of 1999 each. It means 7 courses of value 13,993, but you are going to get it only for 2,599 and it is not yet over. I'm going to give you some more bonus. Course number 8, collateral security is a comprehensive study. Course 9, how to carry out credit risk rating for non-trading entities. Course number 10, in this course you will learn banking credit analysis through various case studies. So now it is 10 courses of value close to 20,000, but you are going to pay only 2,599. It is not yet over. Some more bonus. Course number 11, how to read audit report. Course 12, this focuses on letter of credit, and course 13 focuses on financial analysis in very short duration. So you have 13 courses of value close to 26,000 rupees, but you are going to get it for just 2,599. So it is basically 7 main courses and you are going to get another 6 complimentary courses, 6 courses as bonus. So overall it is 13 courses of value close to 26,000 rupees. It's 1,500 plus lectures. You get lifetime access for all these pre-recorded courses. You can access them in desktop, laptop, mobile, iPhone, iPad, and the overall cost is around 26,000, but you are going to get it only for 2,599. So this is a once in a time opportunity for you. Enroll now. I'll see you inside the course.